Okay, so a big portion of chapter 13 is dedicated to looking at the ratios. And ratios are things that we have learned in prior classes. We learned them in Principles of Accounting 1. And throughout this class, we learned, and they've kind of been sprinkled throughout all of the chapters, right? So at this point, you've calculated them. You understand that each one of them has a formula, right? I've already wrote in this one for current ratio. There's the formula. So you can take the numbers and plug them in, and it's not too hard to do the math, right? However, now that you're in your second year, finishing your second year or second semester of accounting, we really want to know, what do the ratios mean? Right? So now it's time for us to dig deeper. And that's what we're going to do for all of this problem. Same company that we're going to work on, and we're just going to do a ton of ratios. So this, at the top of this page, they did give us a small portion of a balance sheet, and unfortunately, it doesn't give us what we need. So, right, we know that with a current ratio, we need current assets, which are things that are quick or that can be converted to cash within 1 year or less. So all of these four things are what we would consider current assets, things that can be converted into cash within 1 year or less, right? So that means that money could be used to pay our current bills, right? So, and in this case, current liabilities, there's only one, it's accounts payable. Sometimes there's things like accounts or salaries payable, wages payable, income tax payable, sometimes those things. But these are basically your bills, right? So we want to make sure that we have enough money to pay our bills. Yes, that's really essentially what it is. So first thing I'm going to do is I'm going to add up the current assets, because there's 4 of them for each of those years. There's my current liabilities. And I'll put those totals in real quick. And I put those totals in. So now you can see that my current assets have actually increased. They've gone from 147,000 and increased up to 244,000. So they've increased quite a bit, right, over the 3-year period. And liabilities have also increased from 51,000 to about 130,000. So unfortunately, they've both increased, and we're going to look at the math in a second. The real question is, did they increase at the same rate, or did one increase faster than the other? So what we want, of course, is that we have more current assets than we have current liabilities. That's what we want out of this, right? So what you're going to do now in our little problem in Connect is we're going to enter in the total for current assets for each of the years and the total current liabilities for each of the years. So there are the amounts. I've entered them in blue. Again, just taken from above, just taken from that information I just highlighted. And now what you're going to do in your calculator is just divide them. So let's start with the 2 years ago. So this line right here. We're going to take the $147,000 and we're going to divide that by $51,250. So in your calculator, the answer that you'll get is 2.86829, and it keeps going. So what we want to do here is round it. So let's just real quick refresh on rounding. So here's our review of rounding rules. Wow, that was a tough one. So we want to round it to the second digit, which would be like the cents, right, or the hundredths position. So that's the digit we want to round it to right there. So my number is 6. All right, great. I look next door. If that number is 5 or greater, which it is, that means my 6 will actually round up. So it will become 287. And what that number represents is that for every $2.87 of current assets, it's like money, right? For every $1 of current liabilities. So that is good. That is a nice solid ratio, right? Sometimes that ratio looks like that, where they've got the where it says right here 2:1. They've got that there. Or it could also look like this. Let me draw it right down here. It could look like this, 2.87, and they do the colon and then a 1. and these are dollars, right? Could look like that. Anyway, that's what it means. And you always want your asset number, the first number, to be larger than 1. Yeah? Okay. So for the rest of them, here's the numbers we get. We get 252. And for this one, we get 188. Yeah, so here's the deal. That first one was good, but it is decreasing. So it's going down. It's decreasing. And unfortunately, we don't want that. We want it to be increasing. So because both of those years are decreasing compared to that first year, it's worsening. So that would be our answer to this problem. We have a problem. Our assets are not increasing as fast as our bills. So we better look at that again. So what we would do is do a quick analysis. Where's the money? Where are our assets getting tied up into? Have we spent money into some long-term things? And so maybe we need to reassess, right? But even a better ratio to look at is what we call the acid test ratio or quick ratio. So that's this ratio here. And that is a ratio that like you and I would do all the time, because this ratio says, okay, not just current assets. So instead of looking at current assets, I want to look at quick assets. Assets that are either already cash or really close to being cash. So if we go back and look at what assets we were viewing as current assets, which one of those are what we would consider quick? So cash is of course a quick asset because it is already cash. Accounts receivable by definition is also a quick asset. It is when we could go to our customers and say, hey, we want that money right now. And merchandise inventory, nope, that is not a quick asset. Prepaid expenses, also not a quick asset. The other quick asset that we've learned in our book is short-term investments. That's like money when we invest in CDs, certificates of deposits. Those are great examples. We don't have any for this problem, so we can leave that off, but they did give us a spot for it. So now what we need to do is just fill in the cash and the accounts receivable amounts and know that we will be adding these 3 numbers up, adding those up for a total and then dividing by current liabilities. Okay, I've entered the amounts in, and it's really important, I can't stress it enough, that there would be parentheses around these 3 numbers that we need to add up, and those need to be added first. So let's go ahead and do one as an example. So it would be the 37,800 plus 0 plus 50,200. That needs to be added up first. And when you do that, it's actually a pretty number. It's $88,000. Let me fix that last digit there. It's $88,000. Then you divide it by the current liability, which is $51,250. So you do that, the addition first, the numerator first, and then you'll get these answers. So 2 years ago looks the best, right? It's $1.72 for every $1. So we're looking good. Things are good. Now the next year, $1.30 to $1. Okay, it's okay. Unfortunately, it is decreasing, but at least we still have enough money to pay our bills. Now this current year, not so great. We have 93 cents for every $1. So this current year is a mess. This is not good. This is literally trouble. So definitely worsening. They're asking us what's happening. It's definitely worsening, but really we are in trouble. When it comes to paying our bills, we do not have enough to pay our bills. So this is a really big indication of financial distress, truly. So these ratios are used all the time, just very quickly, easy calculated, used to tell us just a simple way of do we have enough to pay our current bills. Okay, we're going to move on from there and move into some of our risk and capital structure, and actually not quite yet. The first ones we're going to do, let me scroll down. There is more information given here, so I still have that balance sheet, but now I'm given also an income statement, which is great. Now the income statement that's given, just note right here, it's only 2 years given, which is fine, because from here on we're just going to do 2 years. However, that 3rd year on the balance sheet we do need because we're going to have to do some averages. So there's two there's my little divider there. So for the very first one, we're going to go over some of the profitability stuff. And I'm looking at days that my sales are uncollected. So I'm sorry, I said profitability. This is a risk one, but we let our customers charge on account, right? We say, okay, customer, we're going to provide a service or sell you something and we'll have you pay us later. That's a normal courtesy in business to some of our larger customers, yes. But the problem is that can actually turn into a financial mess when you let them wait and pay you back and it takes too long. So what we want to look at is how long does it take for those customers on average to pay us. So we're going to take the net accounts receivable and divide it by what we call net sales, which would be sales less any returns, discounts, allowances, that kind of stuff. So when I look at my income statement, net sales, it's just going to be the sales amount. So I've got sales, and then of course up above here in the balance sheet, I've got accounts receivable. So I'll just take those and divide them. And so I've entered those amounts here. And if you were to divide them here, what it would give you is an annual or whatever period we're looking at amount. But what I want is how many days. So I'm going to multiply this by 365 days. So if I take these, divide them up, and then multiply them by 365, and of course, any kind of rounding that's needed. So let me just go over rounding one more time. Let me see what number I get. So the answer to this one actually doesn't need to be rounded. So how about that? So in your calculator, you get 48.504, and they want us to round it to just one decimal place. So this one is going to round to 48.5 days. So 48.5 days. That's how long it's taking us to collect our money. That's not good. Now, I don't know what industry we're in, so I don't know if that's normal for our industry, but typically the 30 is a pretty common number. 30 days it takes to collect, but here it's taking 48.5 days. And in the prior year, it took 42.9 days, so it's actually getting worse. It's taking longer time that we are not collecting our money. Because remember, this is uncollected money. It's our money that the customers haven't paid us yet. So the answer to this one, when they ask, is it improving or worsening? It's definitely worsening. It's not getting better for us. It's getting worse. And to be honest, I already think it is worse because 42.9 seems kind of high too. Again, we don't have an industry number to compare it to, but we could at that point just to see. And along those same lines, we're talking about receiving money from our customers. So that's tied up in the accounts receivable, right? So the next one we're going to look at is called the accounts receivable turnover. Now, turnover, it's not a Danish or pastry that you eat. Turnover is like the life cycle. So what is the normal life cycle of accounts receivable? Like what is the start to finish? Okay, so start, we let the customers, they charge on account and the customers owe us. So the customers owe us, right? They owe us, and then they pay us, and then it becomes zero. That is the life cycle of accounts receivable. So this is going to spin around and around and around, and it's going to spin around throughout the year, right? So this first calculation that we're going to do will determine how many times does that life cycle occur throughout the year. So it might happen 12 times a year. That'd be about once a month. That'd be good. That'd be 30 days, right? But we know that it's going to be less than that because we weren't collecting every 30 days. So for this one, we take net sales and we divide it by average accounts receivable. Now, we don't know the average accounts receivable. We actually have to calculate it. So up here, we're given the numbers and we just need to do it. What we'll do is we'll take the beginning. Remember, for accounts, for any average number that we're going to calculate, when we calculate averages, we take the beginning plus, or I'm sorry, not the beginning. Let's do it this way. The end balance, so the current year end, add the current year end, which is also the beginning. I'm sorry, I've messed that up twice now. Let's start that over. Prior year end, which is AKA current year beginning. That's why I wanted to say beginning. But this problem doesn't give you beginnings. They just give you ends. So let's do it that way. We take these two numbers and we divide it by 2. Two numbers divided by 2 will give you an average. All right, I'll pop those numbers in and we'll talk about those. Okay, I've entered in the amounts and just want to highlight a few things. So remember, when we take these averages, we take the current or the year we're looking at plus the prior amount, and we add those up, then divide by 2. So make sure you're adding first, then dividing, right? So I've got that highlighted here. Let me highlight it with this. Oh, you can't see that. Sorry, let's do it with the black. Remember, you've got to take that addition, add it up first. I showed my work on all of these so you can see that I took those two numbers, added them first, then I divided by 2. That's how I ended up with my average accounts receivable. And whenever you get those average numbers, make sure those numbers fall between the numbers you just added up. So if I were to do like this last one that I'm looking at here, if I were to add these and my average, let's say my answer gave me $156,000 as my answer, 156,000. 156,000 does not fall between these two numbers, right? The two numbers are 50,000 and 62,000. So my answer needs to be between those numbers. And if it's not, then I did the math wrong. I just probably typed something in my calculator wrong. So it's really important just to stop yourself real quick when you get these averages. Make sure the number that you got, so like we got up here in this one, we got $76,000. Make sure it's something between those two numbers that you added up. Yeah, it falls between 89,000 and 62,000. So that feels pretty good. So, all right. Okay, so now we've got those numbers and we can put those in to our formula down here to figure out how often does accounts receivable turn over. Okay, I put my totals in, net sales, and then I divided it by those average accounts receivable amounts that I got above, and I got that my turnover was, prior year it was 9.4, and this year it actually decreased, so it went down, which is a bad thing because here's the deal about turnover, the life cycle. We want that to happen a lot, and so if it starts to slow down, then that means it's getting worse, right? So again, our answer is worse. And that's kind of the pattern we're seeing with this company, right? Which is often the way it is. If you're not doing well in many aspects, it increases your risk and profitability here and vice versa. So yeah, that's kind of what we're going to see here. And just like that, inventory turnover is going to look the same. Sorry to tell you the end of it already, but it's going to be another one that's worsening. So let's talk about inventory. So inventory life cycle, similar to the life cycle of accounts receivable, right? We make a sale, but this one actually we first do the purchase. So we're going to buy the inventory and then we'll make the sale. So that the sale will actually be the end of our life cycle. So this life cycle of inventory, we want it to be continuously moving. In companies like perishable goods, grocery stores, things like that, we really want to see the inventory turning over quickly because it goes bad, right? Some places or some industries like car dealerships or jewelry stores, we're not going to see those move just as much. So for this though, the formula is going to be cost of goods sold divided by average inventory. So we're going to have to calculate average inventory. So let's go back up to that balance sheet. Okay, in the balance sheet, we can see merchandise inventory. It's an asset account, right? So here's the balances in the account. For average of anything, right? We're always going to be looking at the beginning and ending values. Now, in our case, we're given the ending values of every year. So end of last year, so this is prior year, so this is going to be, let's say 12/31 of year, let's call it 1. December 31st of year 1 is basically equal to January 1st of year 2. So that's our beginning balance, you see. So here's our ending balance for 12/31 of year 2, we'll call it. So we're kind of moving up, right? And then this one would be 12/31 of year 0. All right, so for these, we'll take these balances, we'll take the end of our current year, end of the prior year, add them together, divide by 2, and then we'll get an average. The average should fall in the middle of these two numbers, and then we'll do the same thing for this year, where we'll take the beginning and ending, divide by 2, and see if the number falls in the middle. Okay, I have calculated and I've shown all the work for the average inventory. This is the current year, and this is a prior year. So we're going to take these amounts, and sorry, I should have did this before I started the video. We're going to take those amounts down to our calculation. Of course, we also need, before we leave this page, cost of goods sold. We know where that is, right? That is on the income statement. So we need those two amounts that I just highlighted there. I'll zoom in so you can see where I highlighted. So yeah, we need cost of goods sold for the 2 years, and let's take all these amounts down to the place where we're doing our calculation. There it is. All right, so inventory turnover amounts. So I have cost of goods sold 411,225. So I'll enter these in, and then we'll talk about what the numbers mean in just a second. Okay, so in blue there, I entered in the amounts that we just calculated, the average inventory, make sure those numbers fall between, right? And then cost of goods sold, we got that from the income statement. We're going to divide those numbers, and we get the number of times that inventory turns over. So remember, what we're looking for is the life cycle, the buy, sell, buy, sell, buy, sell. We want to see that happen a lot throughout the year. I don't know what kind of industry we're in, so I don't know if this is normal, but last year we had 5.2, and maybe that was good. I don't know, but this year we're down. So when this decreases, when this goes down, that's not good. It means it's not life cycling through as much. We're not having as many sales. So that does mean it's worsening again. So like I said, we kind of keep seeing that with all of our problems, but that's where we're at. Now, inventory turnover, that is going to relate directly to the days the sales are in inventory. So a minute ago, we did all of this for accounts receivable, and we did the days first, and then we did the turnover. This time we did the turnover, then the days. Either way, these two are going to line up together. So for this one, the formula for this is going to be take that ending inventory and divide by cost of goods sold. So we don't have to do any average calculations here. We just have to do inventory divided by cost of goods sold, and then of course, multiply that by 365 days so that we can find out how many days it's sitting there. So you can already kind of estimate because inventory is turning over 5.1 times. And if that's happening throughout 365 days, we can get an idea of where we're at. So, all right, but I'll put these numbers in and we'll talk about the numbers in just a second. Okay, so the answers for these, prior year was 87.156. So that's going to round to 87.2. So let me take those back. 87.2. This one also rounds. It's 99.9 when we round it. So let's talk about what this means. We want our inventory that's sitting. We want our inventory that sits in the warehouse because we don't want it there for very long, because what should it be? Inventory will become sales. So what we want is we want a low number here. So what happened is we see it go from 87 and it goes up. It increases. That's not good. It means it's sitting in our warehouse more now, more days. So this is definitely worsening. Okay, these next actually 3 ratios bring me back to, I think it's chapter 10 in Accounting 201, that lovely chapter 9 and 10. 9 was bonds and 10 was common stock. So if you remember those chapters in that class. And when I started, usually when I start the lecture for 10, I talk about how does a company get money, like get cash, right? 3 ways. They could either make it by selling things and earning revenue, right? They could borrow it, so have debt. Even bonds are considered debt. Or they could go to the shareholders in the market and ask for basically like a gift, like you invest in me and then I'll give you some dividends in return and it will be great, right? So these next 3 ratios that we're going to look at are looking at leverage. So how much are we using, how much are we getting from shareholders versus banks. Where are we at with this? Equity and debt. So the formulas for these are really simple. The first one is total liabilities divided by total assets. The next one is total equity over total assets. And the debt to equity is going to be total liabilities to total equity. Okay, so here's what I want to make sure I put this at the very top of this page. Let's not forget the basic accounting equation. Assets equal liabilities plus equity. So what we're truly going to be looking at is three numbers, and we're going to be dividing them up. So the first one, we're going to take the liabilities and divide it by the assets. And then the next one, we'll do the equity over the assets, and then we'll do the liabilities over the equity. So we're going to end up with mixing them all up to see them all, right? So let's focus on the first one. But before we do that, we got to go up to the balance sheet because the numbers actually aren't there right now. We have to make them. So let's take a look at that. Oops. And having trouble with my iPad. So you see, I'm actually stopping my video quite a bit too because it's giving me a lot of errors. So anyway, when we look at this balance sheet that was given to us, we see that they lumped together liabilities and equity. Wow, I even lumped it together in my Word. So we're going to have to do some totals in here. Not a big deal, but I do see I got two payables here. Let me switch colors, but we've got two payables. So of course it's accounts payable, long term, notes payable. So we're going to lump those two together, get some totals for each of those. We don't actually need that final year, so we'll close that out. And then we'll get the totals for the other two, which is common stock and retained earnings. So we can get those totals as well. So we'll total these out. And here are the totals for them. Actually, I've got them right here. So I've got those totals wrote in, so you can look those over. So I'm just going to put an L next to this one because it's liabilities. And I'll put an E next to this one because it's equity. Put that one down here. So, and then of course we already have total assets. So total assets, that number was given. So I'm just going to block those ones off as well. And I'll put a couple A's next to those. So we can see our A, L, and E. So remember, mathematically, those will balance. Assets equal liabilities and equity. But we're just going to divide it up and basically see where we end up. And truly, we do need to show our work for all of them. But once you calculate one of them, the other is going to be the difference between 100% and that. So I'll show that to you in just a minute. But we don't want a shortcut, so we'll do it all the long way. All right, so we're just going to take all of these amounts. I'm going to kind of highlight them just a little bit. We're going to take these amounts down to our equation. And there it is. All right, so we'll enter those in now. Okay, I have the amounts entered in, and try not to cut it off too much. I have the answers from my calculator written off to the side here because what we need to understand for this ratio is that this is a percent ratio. So the calculator number that we have is not a percent yet. So first thing we're going to do, remember we've done this before, but first we need to convert to a percent, then round. Okay, so it's got to go in that order. So first let's do the bottom one. So first we're going to convert this to a percentage. We'll move it over 2 decimal places. So now it's 39.719%. And now we're going to round it to 1 decimal place. So we're just going to look at that 7, and it's going to stay as a 7. So it's 39.7%. So that's 39.7%, and I mentioned this a minute ago, so that's roughly 40%. So when I go to do this equity, the equity ratio, the other side of this is going to be the 60% to make these two equal 100. So I kind of already have an idea of what it should be, right? So I'll leave that 60 there just so we can see it in a minute. All right, so this one we converted over to a decimal, or to a percent, sorry. and then we'll round, and it's actually going to round up. So it's going to be 43.7%. So I know that's 43. So my next one's going to be about 57, 56-ish, right, to make it 100%. So not much to say about these because numbers are numbers. There's no, is this getting worse or better or anything. Some people say liabilities are good. It's a debt financing is great. Others say equity financing is better. So it just depends on who's interpreting it and what the investor themselves think. Okay, so we did liabilities by assets, right? So I have that highlighted at the very top of your screen in blue. I'm going to take those highlights away. Now let's do equity divided by assets. So this is how I said, oh, I know it's going to equal 100% because I'm looking at the same numbers. It's one math equation and it has to work out. So for example, this first one, when I divide it up and I put in the equity and I divide it by the total asset amount, it's actually going to equal perfectly 56.3%. And the next one, when I enter those amounts in, will perfectly equal 60.3%. Now, there is no analysis of this. Some people say equity is a better financing. Some say liability is a better financing, but there's no better or worse here. It's just numbers. Numbers are numbers. So there they all are. Okay, so let's watch carefully at the top again. So we just did equity over assets. Now we're going to do the last and final one, and we're going to do debt. Sorry, so I got to start this way. Liabilities to equity. So now we're going to look at these two numbers. And I guess I could have drawn it. I guess I could have drawn it out a little bit, but that's okay. So we've looked at all of them at this point. We're going to come down here. We'll enter in total liabilities and total equity. Now this one is going to be just a regular ratio. So we'll do this to one decimal place, two decimal places, but we won't need to convert it to a percent. So back to the way we did earlier, basically to the cent. So the numbers are listed there, and had to do a little rounding, but for this one, I want you to think about it this way. Debt is, some believe debt is okay, it's good, but let's just say generally speaking, debt we don't want much of, right? So we want small amount of debt, yeah. And then over here for the equity, we want lots of equity, right? We want to look good there. So similar to what we were doing with the current ratio, that's what we're looking for here. We're looking for small debt though. So now we're looking for a smaller first number compared to our dollar in the end. So these are looking okay. I mean, 0.66 to 1 for the first year. The problem is it goes up. And so what happens when it goes up, it means debt has gone up. So because of that, it says, does a company have more or less debt? They have more debt. So because of that, we're not going to say worse or better because some believe that debt is good, right? But at least we can look at these numbers and immediately know, oh, they have more debt than they had last year. So that's a big deal, right? That means something has changed and we would want to look at the financial statements a little closer. And one thing to think about too with all these ratios is these ratios are how a lot of investors, they throw, the computer systems will do a lot of these ratios for them. And then what the computer spits out in an answer will determine what they want to look into deeper on the financial statements. So they kind of use it as where to start searching. And then they use it to compare to other companies in the same industry. So that's one thing we're lacking with this problem. We're not given that, but it is definitely a critical piece of it. So, okay, times interest earned is like this. Basically, if you're going to borrow money and pay interest, right? So interest is, for some people, right, it's part of life, right? It's like, you know, you're going to own a house, you might have some mortgage interest. So, but the question is, if you're going to have a mortgage on a building, a business, right? Or if you're going to borrow money and have interest on a loan, are you making money, enough money to pay that interest? And how many times are you making enough money to have paid that interest? So it's kind of a weird thing, but we just want to know, like, in our bottom line number, which we actually don't use net income, we'll use a different number. is how many times is that covering our interest charge? So the denominator is interest expense. That's kind of the easy part. Oh, and I didn't spell that right. There we go. And the numerator is something that I learned in school. Is called NIBIT. So it stands for net income before interest and taxes. So we have to take out interest because that's what we're going to use to compare this to. So of course we have to take that out. And income taxes is like part of life. So they want us to take income tax expense out too. So let's go up to the income statement and look at that number. I think we have to calculate it. So let's go up there and take a look. Okay, here we are at the income statement. And for this one, the interest and income taxes are right here. And we have to pull those numbers out. So basically we want to redo the income statement to not include those. We want those, I don't want to cross them off too hard because I need them in a minute. We want those amounts. So a couple different ways you could do it. You could just start over and you could say, all right, sales minus, and there you go. And you'd get an answer. Or you can take this bottom line number that we have, which is 31,100, and you can add back the two things that you don't want to be there. Now we add them back because they were subtracted. They're an expense, so they were subtracted. So if we add those back, we'll get what we call NIBIT, net income before interest and income, oops, two I's in there, before interest and income taxes. So it's 52,725 for that year. So you could also, just like I highlighted up above, take that sales amount and subtract both of these expenses, and you could come to that same amount. All right, I'll show it for the prior year as well. So when we do a lot of these things, we're doing a lot of math, we're adding, subtracting, and all of that. And oh, I meant to add a note here. So we want to cancel out. So I know I kind of mentioned it a minute ago, but we want to cancel it out because it was subtracted. Anyway, so we're doing a lot of math in here. It's important whenever you get an answer to look back and say, does that make sense? Does that fit what it should, right? So for example, my net income was 29,000 and I'm adding back over 20,000 to it. So is my number going up? Is this number increasing? Yes, it is. If somehow I ended up with 9,000 as my answer, oh, I didn't do that right. I must have subtracted 20,000. So just look at your answers to see if they seem reasonable, right? So, all right, so we're going to take these amounts, these NIBITs, and of course we want the interest expense amount. So that amount is buried in there too. So I'm going to need the 12,100, 13,300. We need those amounts and we'll take those down to that formula. Before I was about to scroll down, I looked at the colors I used and noticed I did a very Christmas theme. So that's kind of fun. So anyway, we scroll down here. Let's enter those amounts in and see what our answers are. And I decided to keep it Christmassy here. So I've entered in those amounts, right, for the current year and the prior year. And what I do want to remind you too is that we're looking at interest, the interest amount, I'm sorry, let me say this right, times interest earned. We want this number to be high. Basically what we're saying is, you know, like the like our amount of money coming in profit, is it covering the cost of whatever loan it is that I have? And yes, it is. So prior year was 3.9 times and this year is 4.4 times. So we want the number to be high, and in this case it actually increased, which is crazy. It went up. And so that's great. And honestly, what I would look into, because we know that debt has gone up, and I'm not sure, I don't think our long-term debt went up. I need to look at that real quick. So long-term debt went, it went up over the 3 years, but it went down from the last year to this year. So we must have paid something down or refinanced something. Maybe also interest rates went down. So we are definitely on the less risky here because the times interest earned went up. And I do wish we could end on that one, not because I want the video to be over, but because It's a positive one. So, but we're going to switch back to basically the negative. So this time we're looking at profitability. This is called the profit margin ratio. This is when we take net income and we divide it by net sales. Now these numbers are given in the income statement. So there's nothing I need to do other than just go get them. So if you scroll up to the income statement, and I have a lot of trouble with my iPad, I'm going to try and hope that it doesn't. There we go. Okay. So if we move back up to the income statement, we can see, and I'm sorry, I have to do it the long way. And I made a mess of this income statement, didn't I? But let's highlight maybe some yellow. Of course, we've got the net sales. We've used that a million times. And then we do have net income. So there's my net income numbers. So we'll take that net income, divide it by net sales, and we'll get some numbers. So this ratio is a percentage ratio. So remember, first thing we need to do is convert to a percent and then round. Okay, so I did write out just one of them. I think we've done it enough times, but in your calculator, first round it here. And then, so we got 5.5216. Now you'll round it to 5.5%. So, okay, so what is profit margin ratio? So profit margin tells us that for every $1 of sales, that's like the top of our income statement, what happens by the time we get to the net, the bottom line number? So you could think about this with your paycheck. You got gross pay minus all the way down till you get to net, right? So of course we want it to be somewhat there, right? We want some money. So for every $1 at the bottom, at the end of the day, we end up with about 5.5%. So it's low, but maybe that's okay in this industry. I'm not sure. But the real problem is not that what the amount is. It's that when we go to the current year, it goes down. It's decreased. So that's worse. So we definitely don't want it to decrease. If anything, we want to see things stay the same or get better. So we're back to the worsen as our answer for this. All right, and the last two, and I don't want to lump them together, but the last two, they do need a calculation for total average assets. So for this, I'm going to go back up to that balance sheet page, and I am going to, I just did total average. I meant to say average total. Not that it matters, but average total assets. So let's, I'll get these put in here, but let's go back to the balance sheet and we'll take beginning and end, divide by 2, and we'll talk about those numbers. Okay, so I wrote down the calculations at the bottom. We did total assets for this. So I took current and prior, and then we took current and prior. So we kind of, let me draw those lines a little better. So we had to take these two. Nope, that still didn't work. Okay, how about in black? There we go. And we divided it by these two so that we could figure out the average. So average assets, again, anytime you do average, make sure the two numbers kind of fall between. So I'm looking at the current year. I want to make sure that amount, my answer there, falls between what I just thought it would be, right? So there we go. Or not what I thought it would be, but what I just added up. So does it fall between those two amounts? Yeah, it does. So we're good to go there. There we go. I'll move that way up there. And then the same thing for the next one. So my average is 411. Did it fall between those two that I just added up? Yep. And again, when we do average, don't forget, you've got to first take the two things you're adding up and add them up first, right? So it's really important because mathematically you can't add and divide all at one time. They will do the divide first, so the order of operations. You know how calculators work, right? Crazy math people. But anyway, so there is our totals that we're going to need to take to that last page. I think it's the last page in our packet. Yay. Okay, here we are looking at that asset turnover ratio. So what should assets do for us? Well, they should make money for us. So this one's a little harder to think about, but when you buy an asset, you buy it to make money for you, right? So, or I guess personally, we have other reasons to buy assets, but businesses, they don't just buy a machine because they like it. They buy a machine because they want it to make them sales, right? The machine helps produce something and that relates to sales. So what we'll do here is, again, what we want to see is a high turnover. We want to see this number increasing or staying the same, right? But what we want is sales. So if I enter my sales in, we want to make sure that sales over our cost or our average assets is a high or high enough number. So for us, for this company, it's 1.4. Again, I don't know what this industry is. Maybe that's pretty normal. Actually, last year it was less than that. So we're doing better this year. The turnover is increasing, so that's good. Now, they didn't ask us for this problem, or at least I didn't put it in my notes. I don't know if maybe it is in Connect and I missed that one, but that's that one. Now, return on total assets is kind of a similar idea, because similar to thinking about turnover, in this one, what we want to think about is, are we getting a return bottom line number? So now we're not looking at net sales, we're going to look at net income. It's our bottom line number making us money. So it could be as simple as, hey, I'm thinking about maybe making fishing poles and selling them. Well, that's great. Sales, you can sell the fishing pole for this amount, but what's your bottom line? What's your bottom line number? And does it really cover the cost of buying that asset, the machine that you need to build these fishing poles? And I just thought of that idea because my son just brought that up. He mentioned that you could buy a machine or something. I don't know. I don't know anything about fishing, but it was just an interesting thing. So, of course, we can take the amounts. Net income comes from the income statement. So we've looked at those numbers. If you don't have them memorized, well, I just about do. And of course, average total assets, we just did those. So I've got those two numbers to enter in. I actually don't remember this one, so let me look that up. And I'll put those answers in and we'll talk about those. And I know we've talked about rounding a million times, but I still wrote it in. So remember, we first convert to a percentage. So this is 6.425. Then we do the rounding. So 6.4 is the percent here. Now we do want this return on total assets to be high because what that tells us is that the bottom line take home number, right, net income, it is covering this portion of total assets. It's covering 6.4%. So, and we did look at some other ratios in the chapters and the payback period. So how long does it take to get the payback on this machine? Oh, we've done that one. This one is, we're not going to expect a high percent here. It's just like your net income amount is always going to be lower, right? But going into business, there's always that risk. But assets are kind of part of business. You need to have them. You need to have them because they are going to make you money for the most part. Now, the problem with this one is that of course, we want this to be high, but it's decreasing. So the fact is that it didn't stay the same and instead it decreased. If anything, we want it to go up. But because it decreased, it means it worsened. So we're kind of back to that worsened situation that we've been in just about this whole time. So, all right, well, that's it for this problem. I hope you learned a lot about ratios.